I'm Mario Martinez Jr., CEO and founder of Ingresso, and we are the creators of flymessage.io, the free personal writing assistant and text expander application. On each episode of this podcast, you will hear from sales leaders, practitioners, and influencers to help you grow your sales numbers at scale. So, get your pen and paper or iPad and keyboard and start taking notes as you're now listening to the Modern Selling Podcast. Ladies and gentlemen, welcome to this episode of the Modern Selling Podcast. And I'm your host, Mario Martinez Jr. I'm excited to be here with you today because, yes, as you all know, I've had a journey here of converting Ingresso from a service company into a SaaS company, and we've been out there hitting the streets in terms of fundraising, and I get to invite my friend and the managing partner and founder of Team Ignite Ventures, which is a venture capital firm out there investing in early stage companies. So I'm super excited about this topic because you're going to be able to get some inside scoop on what it takes, what do you need to do, and what VCs are thinking about when they're looking at investing in you. Hey, Mr. Brian Bell, welcome to the show, my man.
Thank you for having me, Mario. It's a pleasure.
I'm excited to be here with you. Now, do me a favor. I told everybody who you are, but just give us a little bit of background about your background and then as well as the venture firm as well, Team Ignite.
Well, yeah, I think it'd be exciting for your audience to hear I'm, originally very much a sales guy. I mean, I started in 6th grade selling out of a magazine door to door. Actually, maybe even earlier than that for school fundraisers out of magazines and, probably 2nd grade. But, had the paper out, going door to door, getting subscriptions for that. I sold electronics at Sears and then The Good Guys, a West Coast electronics retailer. All through college, sold cars, sold financial advice before I ended up on Wall Street. Then I washed out and I sold some more. I sold commercial real estate for a while in Hawaii of all places. And then when I got to Silicon Valley, I actually started in sales as well. I was selling solar systems at a little startup called One Block Off the Grid before I switched to marketing and then product. Got really deep in AI over the years, led the AI category for AWS. I launched SageMaker Marketplace, which was really a sales job. It was a BD technical kind of job. I think you're always building stuff or selling stuff ultimately. And then I went over to Microsoft. They recruited me to lead a large cross-functional BD team that would recruit startups, sell them on Azure Marketplace, sell them on Azure, partnering with Microsoft. And then I wrapped up my career at Microsoft in sales before I launched the venture fund. So, it's been one long career arc of sales. And, venture capital, a lot of people don't know this, is basically a sales job. I'm selling founders on taking my money, right? Why should they take my money versus anyone else's? And I'm selling LPs on why they should give me money versus all the other G's like me out there. So anyway, great to be here. That's a kind of a long-winded intro.
And to clarify, for those people that don't know what an LP is, Brian, can you please articulate what an LP is?
Yeah, that's a limited partner in the partnership venture capital structure. Usually there's something called the LP entity, which is a limited partnership, and LPs pool money in there with all the other LPs, and I'm the general partner that goes and deploys that capital into startups and hopefully generating a return that's above and beyond what they can get in mutual funds or other asset classes.
And about Team Ignite, a little background about the venture firm. Who do you guys invest in? What's your guys' focus, etc.?
Yeah, so Team Ignite really was born out of my experience at Amazon and Microsoft helping startups scale in the cloud channel. And I slowly realized instead of running a large team as I was having a lot more fun talking to founders. And at the time, Microsoft stock had tripled. So I had a bunch of money flowing in the Fidelity account, so to speak. And so it flew right back the other side of the Fidelity account into a bunch of startups and venture funds. I started as an angel. Did that for a couple of years and wanted to do more. So I started Team Ignite. And the vision for that, of course, was to ignite startups as a team. And now we have over 2,000 members, partners, and mentors that can help ignite startups. And that turned into mini syndicated investments, which are basically pools of capital to invest in early stage startups.
All right. So these are folks that essentially either are building a product, have a new product, and or have just found product market fit, that friends and family pre-seed stage round. Is that correct?
Yeah. I mean, there's so many flavors of, call it pre-series A these days. I mean, there's the friends and family round, which could also be characterized as like sweat equity, right? You and a couple co-founders just burning the midnight oil after work, trying to hack something together that people will actually pay for. Maybe you get a little seed funding, and then there's things like venture studios and accelerators. Once you have something and an idea, or at least a working prototype to accelerate that, then there's the pre-seed round, which typically I think these days is characterized by having some revenue, typically 5,000 to 10,000 monthly revenue, if not more. And then there's seed and seed extension, and there's so many flavors now. It's hard to delineate them all.
And we'll get into this a little bit more in terms of, how venture firms look at investing in startups and your guys' personal philosophy as well. But before I get into some of the details, and I want to take us through the types of rounds that founders may be looking at in the seed or in the friends and family pre-seed and seed round, do me a favor. Tell us something nobody knows about you, even if they're looking at any or all of your social profiles.
Somebody not know. Maybe I haven't mentioned this anywhere. But, I worked full time in college. I first in my family to go to college, and, basically paid my way through school with very little debt. And I think in hindsight, that's not the right way to go through college. I mean, it was a necessary way for me at the time, having, not rich parents or anybody who could pay for it. But I think in hindsight, I would have rather done the more traditional university experience of living. I never lived on campus, and I work in 40-hour weeks, and just sort of, I think that it led to a disillusionment in my mid to late 20s, where I was like, okay, I've been working really hard, and I don't even know what I really want in life. So I went through like a quarter life crisis period. But yeah, I think that's something that not a lot of people know.
Hey, man, I was totally there with you. I did live in the dorms my first year, and I am cut from the same cloth, didn't have money. I worked full time. I actually applied for over 250 scholarships and grants to be able to pay my first year, and then worked my first year in order to be able to pay for the second year. But I did live on campus, and I lived at the dorms, and I will say that I still didn't have the experience that most people have, right? Because I was constantly in, out, all the time. And I didn't go through, quote, midlife crisis, but I definitely have, man, what would life have been like if? And on the other hand, though, as I was on your podcast, the Ignite podcast, what is the name of your podcast exactly?
That's it, the Ignite podcast, yeah.
I was on your podcast, and I did tell a story. By the age of 21, I was making six figures. So there are some things that, you can't complain too much about. And I think I mentioned to you at 22, I bought my first house right here in the Bay Area. So, I had a great early career there in terms of focus and what I was trying to do. Nonetheless, it's driven me right to straight where I'm at now. And with that in mind, let's talk a little bit about venture capital and the fundraising process and what VCs look for. And people asked me a year ago, they said, what was the hardest thing you ever did? And I said, by hands down, it was a 7-way company merger to originally form Vingresso, which was 7 companies. That was absolutely the hardest thing. I'll never do it again. It was way too complicated, but it worked, and we grew to be the largest digital sales prospecting training company. And we kept 4 of our original founders for the first 5 years of the company. That having been said, now, if you ask me what's the hardest thing you've ever done, I would say hands down venture capital fundraising. It is very hard, especially in the 2023 year. It was almost impossible. And I think the stats that I saw was deal volume was the same, but investments were 50% less, right? So it's pretty rough out there. With that having been said, talk a little bit about, let's first start with, traditionally speaking, someone goes to raise a friends and family round. What does that amount look like? Is it 50,000, $250,000? Someone goes for a pre-seed round up to how much, and then a seed round up to how much? And what are kind of the revenue thresholds that, just generically things kind of fall into line with?
Yeah. I think friends and family is, hey, I have a proof of concept MVP. I've been hacking on something at night. Maybe it's just a slide deck, up to 250,000 typically. And that just really comes down to how many rich people do you know, friends and family, who are willing to part, with a, 25K or 50K. There's this famous example of Jeff Bezos going around to his friends and family, trying to raise money for Amazon and basically forcing his parents to invest, which ended up being worth that 25K check or whatever it was, being worth billions of dollars, obviously. He goes, no, you need to give me the money. This is going to be big, which is really funny. But yeah, that's the friends and family. And it's difficult for me as a VC, right? Because I've had to turn down friends and family for money because I don't invest in friends and family rounds. Maybe in the future, if I'm, sitting on 7, 8, 9 figures or whatever, I don't really care. Here's 25K, but that's not me yet. So that's typically the friends and family. Pre-seed is could be as small as 250, but typically it's 500 to a million and a half. And these caps, the valuation cap, which is the valuation of the company that you're buying into, can be as low as 2.5 in a pre-seed up to 10 or 15. I mean, some of the AI stuff you see is pre-launch, pre-rev at 15 or 20 $1 million caps. And then you get into seed, and seed is an amorphous term because on one hand you got like Y Combinator companies coming out and calling their rounds a seed, which is they're really pre-seed because they're scratching on back to the pre-seed. You probably have 5 to 10K of monthly recurring revenue, typically somewhere in there. But seed, you're starting to get some pretty significant revenue, maybe 20, 30, even up to 40 or 50,000. I've definitely been in some deals where, they got 600,000 of ARR and I'm able to get in at a 6 or 9 cap, $1 million cap. And then, so that's the seed. And seed can be like as low as $1 million up to 2 or 3, even 5 million. There's a big disparity there, a big range. And seed today is really what A was 10 or 15 years ago. Things have gone progressively earlier. And then there's the seed extension, which is like, oh crap, we didn't get to, the million or 3 million of ARR that it takes to get to an A. So let's do a seed extension, take a little bit more dilution on our safe and hit some more milestones before we get to A. And A has become a big milestone for startups. If you get to a Series A, that means, okay, you've really worked hard and really got something here. You probably have $1 million up to 3 or 4 million of ARR, annual recurring revenue, and it's a big milestone. It's typically a priced round versus all the other rounds before it are, on a safe or a simple agreement for future equity or convertible note. So you've really reached a big milestone in your journey, and typically the investor's writing, $1 million up to even 4 or 5 million into the round. And they're taking a board seat and things like that. So,
gotcha. That's super helpful. And actually, it's right in line with exactly what we have been doing as well. When we raise pre-seed, 230,000 right there. Not pre-seed, excuse me, friends and family, 230,000. And then our pre-seed, we're sitting at about 680,000 right now. And the goal was to get to about 1.2 million on the pre-seed. You nailed it. We're at a $4 million valuation cap for those, the people are listening in terms of what we do, what we've done. And I'm just talking about my experience. I'm not talking about soliciting for investments. But that having been said, and then, we're sitting at that 10,000 in ARR, and the goal is to get to that first milestone, which is 25K in MRR, right? So that's where you're sitting right there at in terms of driving towards that particular goal. And then the next one will be seed round, where, you're looking for about 3.5, anywhere between 3 to 5 million. But for us, our target would be about another $3 million worth of investment. So you nailed it in terms of exactly our path and what we're doing. Now let's talk about, again, looking at the hardest thing that I've ever done is venture capital fundraising. I've got founder friends.
Yeah, me too.
40. Yeah, exactly. Because you're on the other end where you're actually raising from LPs for your fund to invest in founders, right? So you're doing the same exact thing. And when I talked to founders, it was interesting early on. A lot of my founders who had been successful and have done Series A, B, C, and or D, they got to those particular points, all said, listen, if you're not doing 200 to 350 venture capital meetings to get 1 to 3 bites, then you haven't done enough.
It's basically a sales process. You're running a sales funnel. You identify your targets and you start doing cold outreach, warm intros, whatever you can do to get, your deck in front of them and try to schedule meetings and following up. Hey, thanks for looking at the deck. And I, get 15 minutes. It's the same thing as like selling a product. You're selling your startup in this case, but yeah, same process.
The only difference is my close ratio sits between 30 and 40%. And after the friends and family round, by the way, so in the friends and family round, I did a crowdfunding campaign because of our social influence. And I met with 190 individuals, and I closed 149 of them. So that was a really, really high close ratio, even if it was $100, right? I got anywhere between $100 and $50,000 checks. That's what I got in that crowdfunding. So I was pretty impressed. But then when I started hitting the VCs up, I was like, oh my God.
Yeah, you're lucky to even get them on a call. I mean, I had a founder this morning and he was like, hey, Brian, it looks like you're out of town next week and maybe the week after too. And I'm like, no, I'm just back to back. Like, that's my life. That's the life of a VC. We're just back to back to back all the time. And now I see why, as an outsider looking in, it was such a cantankerous bunch of folks, right? I was like, gosh, you guys are really, irritable. And it's because we're like an ATM machine that everybody wants to like figure out the PIN code, right? And so we're just sort of constantly bombarded with pitches and, hey, can I just talk to you? Can I just run something past you?
Get some advice?
Can I get some advice? I get like 50 connection requests a day on LinkedIn at this point, and I can't even get through them all,
Yeah. If I had a penny for everybody who asked me, can I get some advice and spend a few minutes with you? It's like, I finally got to the point, especially talking from a social media influence perspective. Look, I make my money off of talking to people, right? So if every person I spend, half an hour with that asks me for it, like, I'll never be able to sell anything. So, you've got to be really, really, really careful. And I understand that on the venture capital side as well. Let's talk about the things that a venture capital firm is looking for when they're evaluating a founder. And I know I've got a lot of different ideas of things that people are looking for, but you've got a whole framework that you guys use specifically that I think mirrors very closely with a lot of things that I've seen as well. And so in your framework, you talk about, or you emphasize the technology, product, design, all those things that are clear. Like, could you take some time to elaborate on how you balance the technical innovation side, especially in a new early company, with market needs and usability, especially, like as I mentioned, in an early stage startup?
Yeah, I mean, I'll start by saying there's no right way to do venture capital, but there's plenty of wrong ways. And so what that means is every startup and every founding team are beautiful snowflakes, and they're all unique in their own particular way. And so what you're trying to do is you're trying to look for easy yeses that fit your thesis, right? And, everyone has a different thesis, right? Like, a different way of adding value, a different kind of slant on the market. And you're hoping over time, you think that will lead to alpha, which is outsized returns for a given amount of risk, right? So that's kind of what you're looking for as a VC. You're trying to look for teams that will break down walls and ring the NASDAQ bell in 10 years, come higher, hell or high water, right? That's kind of what you're looking for, right? And there's lots of things that go into that, right? There's lots of easy no's, probably 70, 80% of what I see on a daily basis, and I look at 500-600 deals a month, is an easy no. I just come like, no, doesn't fit the thesis, not a good enough team, shitty deck, shitty product, whatever it is. Like, you can just kind of tell right away. And I've been there. I've built lots of crappy things that nobody used. So I recognize it because I've been there in my career where I just didn't build very good things. And so I think from a team perspective, it's hard to suss it out, but you're looking for a crazy amount of commitment, right? And, that can come in all kinds of shapes and flavors, right? Oh, I just left a cushy, general management job at a big tech company. Well, okay, like, you're probably pretty committed to doing this if you walked away from a 7-figure job to go do this startup, right? You're looking for like somebody that, the force is strong in them. And what I mean by that is, wow, they are so enthusiastic, and like, they're selling me on maybe I've made the wrong career decision and I should quit my venture capital career and go work for them. Like, if I meet somebody like that, where I'm like, this could be like the next like Google, or that level kind of thing, and kind of makes me question like what I'm doing with my life. That's kind of what you're looking for. Like you look for a history of success, like, and that can come in lots of shapes and flavors. I mean, that could be like, oh, like I dropped out of Harvard, right? Well, getting into Harvard's pretty impressive, but then dropping out, that shows commitment and that you're, going to do whatever it takes. I have a couple other like interesting, like little things I look at. Are they interested in like, do they have a real big vision, right? Do they see themselves doing this in 10 or 20 years? And the way I'll flesh that out is like, hey, where do you see this in like 10 or 20 years? And be like, oh, we'll get acquired. Google's going to acquire us in 3 or 4 years. I'm like, VCs don't want to hear that because it takes 10 years to build a $10 billion company. You just can't do that like in 3 or 4 years. I mean, maybe now with the AI stuff, like maybe, but so you're kind of looking, are they looking to create value or just chasing valuations? And then I have another couple like little check marks, like, do I trust them? Would I trust them with my kids? I have 3 kids. Like, would I just let them watch my kids? And that's like kind of important. You and I both have podcasts. So like, would I want this person on my podcast? That's another kind of question. Do I want my brand and my personality and my persona affiliated with this person? And, because it is, I mean, this investor startup relationship will last longer than most marriages. So you're kind of going into cahoots with this person for a really long time. There's a long list of things I look for: tenacity, vision, clarity of thought, people skills, passion, purpose, risk-taking, long-term thinking, customer focus, optimism, thinking based on first principles, ability to experiment and learn, coachable. So I'm trying to suss all that out in a 30-minute call, by the way. That's really hard. Sometimes it takes multiple calls. Sometimes it takes back channel. Sometimes it takes just like perusing their LinkedIn and Twitter. But yeah, that's a long-winded answer. But yeah, that's kind of what I look for in the founding team.
So you described and spent a lot of time on the founder assessment side, which is key because, again, I do investments myself personally as an angel investor. And one of the first things I'm looking at is exactly as you described, like, is this the person that is going to take my money and is going to minimum 12 exit or more, right? It's really focusing on that. But going back to the product side and product innovation, design, those types of things, how much weight is placed on the actual technology in the early stage of like pre-seed?
Yeah, again, it's like it has to, like, these startups are beautiful little snowflakes, right? And they all have to kind of align. And so typically we're looking at about 15 things in our framework, which is out on my Substack. I think you've read it, and it's out there in public. And I created that article because I see lots of stuff that I don't like. And so I wrote this thing, and I say on the forum, like, hey, go read this and then submit this form. And inevitably they don't read it because I can tell, because they didn't answer the questions in the way that I told them to in the article anyway. I think product and design are very important at the early stage. Like, can you build a good product, right? If your idea has any merit, there's probably 3 or 4 or 5 teams working on it. So why are you going to win? One, like, it comes down to all the stuff we talked about with the founding team, but then you have to execute and build something amazing. And so you're kind of looking at the demo, you're kind of trying it out, kicking the tires, and that, I have a sales background, but I also was in product management for years and years. So I built lots of stuff, both at Microsoft and lots of different startups. So when I dive in, I can kind of tell, is this a good product team or not? Like, can they build? Can they build great experiences? And so I think that is important. We typically won't invest if the demo doesn't look good, or if we try it out and it doesn't feel good.
Makes sense. So make sure your product is user-friendly. That's for darn sure. Thinking about the dynamics of maybe the founders or co-founders, I think your framework, if I'm not mistaken, suggests that you have a preference for startups with multiple co-founders. Talk about a situation where the team dynamics played a role in your decision to invest or not to invest.
Yeah, I mean, we definitely prefer to have 2 or 3 co-founders with complementary skills. We feel like in our experience leads to more success. 115 portfolio companies for Team Ignite over a 6-year period now. So we've been a pretty active investor, and that's just ramping up. We now do about 50 or 60 a year. So that'll keep going. That number will go up pretty rapidly. And we've noticed, out of 4 shutdowns, all of them are solo founders. Every single shutdown we've had, and we've only had 4, which historically or statistically you should expect 40 or 50% or more to shut down. We've only had 4, and that was, those were solo founders, and it's just really hard to do this by yourself. Now, it's not a hard and fast rule. I still have solo founders in the portfolio. I still write checks to solo founders. It's not an absolute no, but it is a ding, right? It is a ding on the whole package, the beautiful little snowflake that we're looking for, right? So now everything else has to be even better, right? Because you have to get to an easy yes.
Yeah, interesting that you mentioned that. Totally get that. Also, I think we talked about this on your podcast, right? Like if I were to redo this all over again, I would go to market with a technical co-founder instead of learning it all on my own. On the flip side, I have the opportunity to be able to learn all the products and all the technology components. Although I don't write a line of code, I definitely manage the technology team, and I'm definitely in the weeds. And I'm definitely helping solve problems based upon a business mindset of where I'm doing analysis of A plus B does not equal C. So let's go ahead and look at that where the A and the B point is, right?
Well, the inverse can happen. What you're describing is sometimes, we've backed technical teams. On paper, they're amazing, right? Google engineers, like who wouldn't write a check to those guys leaving Google, the cocoon of Google to start a company? It turns out they don't know how to sell. They don't know how to talk to customers. They don't know how to market their product. And all that stuff's really hard. That's why you kind of need to have multiple co-founders, right? And one of the things that you look for is if you can't even get 1 or 2 people to come along with your wild and crazy idea, how are you going to build a whole organization to do that? And so it's like you've already failed the first test, so to speak. I'm paraphrasing another VC, but yeah, you've already failed the first test, which is like getting some people to be wild-eyed and dreamy about your idea.
Yeah, I know. In my case, one of the challenges that I had was if you look at my network and everybody that I'm connected to, I have like less than 0.1% of people that I know that are, propeller heads or tech heads, right? So it was so heavy sales marketing. Nonetheless, I found great resources. We build great product, and we are, scaling and growing the platform. So, it can work, but I think I mentioned this on your podcast. I know that at least 30% of all my VC meetings that I've had, which is a little over 100 VCs to be able to find one right side capital management that made an investment, about 30% said, no, I'm not even talking if you don't have a technical co-founder. And so that was the criteria. That having been said, the other 70% said, I don't care if you don't have a technical co-founder, because the reality is you could be the smartest propeller head, but if you can't sell and market, it doesn't matter, right? So some VCs have different perspectives. And I'm of that mindset as well, that, look, I've talked to many, many, many founders. Just yesterday, I spent an hour and a half with somebody that I truly, truly value in the marketplace, who's building something and has been doing something. And they presented their whole entire, here's what we do, here's how we do it. I'm really struggling. And it took me 30 minutes just to figure out, here's what you actually really do, right? So I'm like, you guys have to nail this down. And it was all because they came from a very different background, right? And so that's super important, is that sales and marketing side. Talk about one of the big challenges that I think a lot of founders make a mistake on is they take their TAM, total addressable market, and they make it so ginormously large because they want to be able to impress the VC that this is a ginormous TAM, and they make all these different individual claims. Talk about how do you validate TAM and problem size claims made by startups?
Yeah, I think a lot of this comes down to knowledge of market, right? Which is why I only invest in certain markets. I don't do consumer, I don't do hardware, I don't do biotech, because I just don't know those markets. But if you're talking about like, oh, it's a MarTech tool, and here's where they're struggling, like I know that space, sales tech, various enterprise tools, things like that. So when you explain the TAM to me, I should be able to get it, and it makes sense. Honestly, I've never turned down a deal because I thought the market was too small. Because like a lot of people turned down Uber because they thought it was too small. A lot of the VCs were looking at it, it was a $5 million valuation, famous angel investor meeting in San Francisco. And they pulled up like, okay, how many taxi rides are there? How many taxi rides per year? Small market. It's not going to be that big. Turns out it unlocked a fundamental need for us to go to point A to point B in a more convenient, cost-effective manner, right? So you're kind of looking at, is this problem a big enough problem with enough friction that people will use this thing once or twice a day, like it's the toothbrush test, if you've heard of that. This is something that people are going to use every single day to solve their problem. And that's why B2B SaaS is so amazing, right? If you can find, even a small group, let's say your TAM is, 1,000 companies, right? If you can get $1 million annual contract value across 1,000 companies, it's pretty big. It's a pretty big outcome, And then what I think the other thing that happens with startups that you have to understand, and I understand this as a product manager, building products and selling products, et cetera, for years and years, is your TAM will shift over time as you solve people's problems for them. Like you'll have this wedge where you enter the market and you're solving, problem A in a very certain way, and then you realize they have problems B, C, and D that you can also solve, and so now your TAM is expanding. Right. And you're able to cross-sell, upsell them. That's why B2B SaaS is so amazing. You get this wedge and then you start building a whole product around the wedge. And that's, crossing the chasm, Jeffrey Moore and some of those theories. So I don't get hung up in TAM that much. Maybe a handful of times I've said, oh, that's too small of a market. But really like, oh, I'm going after real estate agents. Well, how many real estate? 1.5 million? Okay, great. And how much is it? $10 a month, $20 a month? Okay. Like, who else could use this in the future? Oh, I think mortgage brokers could probably use it. Insurance agents could probably use it. And so, the TAM, I don't know. I don't get hung up on it as much as other investors.
It was interesting when we were going to market in our first friends and family, and then pretty much throughout the entire pre-seed, we really focused in Vingresso, that is with our Fly Masters product. We focused in on the product-led growth side, and that was the way we were going to go to market, be able to build that. Now, don't get me wrong, we built product-led growth to a $10,000 a month in ARR, so that's not bad, right? But it was like slugfest, right? Think about how long it took to be able to get there, just be able to get to 10K, and then here we go, and just in the last 40 days, in the last 40 days, we went and closed $60,000 in ARR, right? So it just from 2 deals alone with 100 users. So looking at that, we quickly said, hey, I think the focus needs to be on sales-led growth. Let PLG do its thing, right? That's going to be a feeding ground. And I think that's where we lost probably a lot of investors early on, is they were like, are you really going to be the next Dropbox? Are you really going to be the next LinkedIn? Are you really going to be the next Grammarly? Right? Versus we had a solution that we could take into a sales team, and we could really drive a 5K to 30K deal and make those pops. And those are some of the things that you kind of learn through the process. And as you're growing and building the product, and then you get to the point where, frankly, last year we were like, oh my God, I'm going to run out of money. Right? Like, I need to do something different. So I'm going to go out there and sell. And that's was a fundamental reshift in our thinking in terms of what our go-to-market strategy. And again, you can still have that PLG because, by the way, 50% of our users are all coming from product-led growth. Phenomenal. And it includes everybody and every Tom, Dick, and Harry. But now on the sales side, it's a really targeted approach to selling a solution within the sales space. So I think those are some of the things that people don't really think about. Fortunately, we had enough runway and we had enough time to be able to do this. And that's why I'm glad the way we converted the company was over the course of 13 months, as opposed to, hey, we're just going to, pull this out and go fundraise. And we were able to build the model and start the scaling process.
Yeah. I think you're a great example of founder market fit, right? So you're kind of, you come from a long lineage of, sales roles and leadership and thought leadership and your podcast, and all of that feeds into like, oh, by the way, I have a sales SaaS startup that solves a lot of sales problems because I've been in this for 3 decades. Like that makes sense. And so you can empathize and go sell this thing. And a lot of teams start with the tech and work their way out. And that's just like exactly the wrong way to do it. You have to start with the customer and work your way back to the tech. Which is why, like you said, 70% of VCs you talk to didn't care about not having a technical co-founder. I still think you have to end up building, but I see a lot of companies struggle because they just don't know how to go sell and understand what their customers need.
And did you say the term founder market fit?
Yeah, founder market fit.
Okay, I haven't heard that before. I love that term.
Yeah, you should just have that. We have crazy founder market fit. It should just be the title of your slide.
Okay.
I wouldn't use the word crazy, but yeah.
But I get the point. Crazy, but founder market fit. Yeah, that makes a whole lot. So interesting. So how we built Fly Engage, which was the LinkedIn commenting with AI, and Fly Post, which is the AI for writing thought leadership posts, was built out of a fundamental problem that was taking too much time for a seller to go through and scale and engage at scale. And so in our training programs as Vengresso LLC, we trained the largest of large, Cisco's, ADPs, HPs, Micro Focus, down to companies like Virginia Dare. And we basically showed them how to do it hand-to-hand combat. But there's no scalability in that. And that was the problem. So when we thought about Fly Message and we said, everything's around the message. And if we focus in on the message and saving time, what are all the other areas that a seller is dealing with messaging, and commenting and post creation was absolutely one of them. And we could immediately save time. And that's been our growth cut.
You're building the end-to-end whole product solution around this problem that salespeople have, which is, how do I go do this at scale in a non-repetitive, boring way?
Bingo. Exactly right. Yeah. And that was like an evolution component there where we're like, it matches the thesis. It matches all around the message, all around the productivity savings, and what could we do to help sellers to be able to increase their level of productivity. So I love that founder market fit there. Let's talk about we touched on this, customer acquisition strategies. I used us as an example where, hey, I got to the point where I'm like, I'm going to run out of money if I don't do something different and focus not just on product-led growth. Like, yeah, so that everybody has the history, and this is what we did, Brian. Starting in September, I was like, I'm going to run out of money in December if I don't do something different. So I basically automated the crap out of product-led growth, right? Pulled myself out of even dealing with individual end customers and talking to them and trying to upsell and, those types of things, and really focused in on, I'm going to automate this. And if automation works, hallelujah. If it doesn't, and all I'm seeing is freemium users, which tells Johnny, who tells Suzu, who tells Billy, who tells Bobby, no problem, because that's my referral source, right? So that I can build a referral program through that. And then I said, automate that, and now go focus on the sales-led growth. And that's what I started doing in November, was building a pipeline, of which I'll tell you of a meeting that I recently had with a VC. It was my fifth meeting. And
fifth meeting with a VC?
Yes, fifth meeting.
That's crazy.
And still no decision made, right?
Like what check size?
Well, this one would be anywhere between $500,000 to $1 million.
Okay, that makes sense if you're writing that big of a check. Like, oh gosh, it's like shit or get off the pot, man. Like 5 meetings.
So I literally just sent that message last night to them at 5:45 this morning. It was like, it's time to piss or get off the pot, right? Like that we've had already 5 meetings across 4 months. Like, guys, you neither know or you don't know. You either want in or you don't want in. But anyways, nonetheless,
I think it makes a difference if it's a $1 million check, right? Like if I had an LP that's like, hey, I want a $1 million check into your fund, I would do 2 or 3 meetings with them. After the third, though, I'd just be like, hey guys, I got a bunch of other LPs that are interested, and I've been like killing a lot of time with you. I gotta keep my calendar open for other LPs.
Exactly right. And so coming to this meeting, I thought, what would I want to know if I was the 4th meeting here or 5th meeting here? What would I want to know? And I said, I would want to know what the pipeline looks like, truly on customer acquisition strategies. What does the pipeline look like? If you truly have started focusing on sales-led growth, and you truly are this, quote, sales influencer and sales expert, then show me the money. And so I was like, it was 30 minutes before the meeting, and I was like, let me go open up HubSpot and look at my pipeline. Well, of course, I did exactly what all salespeople do. You have your pipeline on a piece of paper, and you don't have it inside the CRM. So I went in and I popped it all into the CRM. We get on the call and they say, talk to me about your customer acquisition strategy. And I said, we talked about sales-led growth. And he's like, but who are you targeting? How are you targeting? What kind of pipeline do you have? And I said, this is what I said. I go, what are you asking me to see my pipeline? And they said, if you have it, I'd love to see it. I said, fantastic. Open up HubSpot, showed them the pipeline deals, showed I had $500,000 in pipeline there, of which we closed now 60,000. We're about to close another 100,000 from that, right? And they were like, tell me about every one of these deals. Who are you at? Who are you with? Boom, boom, boom. I was just on it, right? And so they were like, I got it. Like that, the legit, right? But I think a lot of founders make a mistake in not understanding this customer acquisition strategy. So talk about how do you evaluate founders and this customer acquisition strategy concept?
Yeah, I mean, this is distribution advantage is what I call it in my framework. Or what's your unfair advantage in acquiring customers is a way to ask that. How do you get to your first 10 customers? How do you get to your first 100? How do you get to your first 1,000? You're kind of looking for what's your wedge, right? Is another way to ask that. Like, is there some unique advantage you have in acquiring customers? Like, you clearly are a sales expert, so you can go out and sell this thing, and here's the pipeline, here's how I run that, and here's how I do social selling and all that stuff. So you're kind of looking for, like, how do you do this? And what's your CAC right now, your customer acquisition cost? What's your LTV? How fast does that pay back? Because CAC's only going to go up over time. So you're kind of looking for, hey, can you pay this back in, 6 months, even 3 months, right? Because as you get to scale Series A and B and you're starting to kind of really turn on the growth, your CAC's only going to go up, right? You're not going to get better at CAC over time. You make some optimizations, but yeah, that really comes down to the distribution advantage. I mean, sometimes it's like, oh, I have a huge following on LinkedIn. I have hundreds of thousands of people on YouTube or LinkedIn or TikTok or whatever. Sometimes it's like, oh, I one of the co-founders is a growth hacker, and he or she helped grow this, company from A to B. So you're kind of looking for like, how do you acquire customers?
Gotcha. And you also incorporated a bit of the marketing side as well. And I think that's where a lot of founders, they fall down at, which is, I don't know how to market, or I don't know how to do videos, or I don't know how to do, right? And we talked about that on your podcast as well, in terms of best practices, like get out there and start evangelizing. Get out there and start putting videos out there. Get out there and form a friggin' podcast, right? Around your domain as a way to be able to scale. Let's talk about the business model. When you're assessing a startup's business model, how do you weigh current profitability against scalability and future growth potential?
Yeah, I mean, there's a few things here, right? We invest in B2B SaaS, right? So typically that's the best business model ever invented. You basically solve somebody's problem, and then you charge them to solve it every month and every year thereon after, right? And then you figure out what other problems they have, and you can cross-sell and upsell them. And so you're looking at things like, on the margin, that nth customer, what's the margin for that nth customer? That next customer that you onboard. So you're kind of looking for that typical software margin of 80, 90%. And that's a pure software business. That's what I invested in. You have tech-enabled businesses that are kind of software on top of some sort of real-world kind of logistic operations, or, there's some real cogs there, like in a standard traditional business sense. You have marketplaces and fintech, which have different kind of business models. So you're kind of looking for, you have crazy high margins on this, so it's going to be really, really easy to scale this. And from a profitability perspective, the reason that I exist is because SaaS businesses are not profitable to start. Now, you can get default alive, and that's typically why we only invest in companies that have 10 to 20,000 of monthly recurring revenue, because they can take the 2 or 3 founders and really trim the fat and be default alive if they had to at that point, depending on where they live and how much salary they're taking, all that stuff. But yeah, you're looking for, margins are strong at a very basic level. And I just don't look at anything else that has very low margins. So.
Got it. All right. So, due diligence process. We're coming up on time here. First off, tell people what due diligence is. I've been in it several times. I've had people start asking me to lift up open up the sheets quite a few times, right? So talk about that and walk through a traditional and or your personal due diligence process.
Yeah, mine's probably a little different from somebody writing $1 million check, right? We're writing a high volume of small checks. And, I think, when a VC starts due diligence with you, they basically said, hey, this kind of checks all the boxes for me. Let me dig in here and see if I can find any reasons to say no. You're kind of like, and I tend to err on the side of like starting due diligence a lot. So I'll probably do at any given time have 20, 30 companies in due diligence. And I have a bunch of analysts on staff helping me, go through the financial statements and, and you'd be surprised how often you're like, oh, you said you had, 600,000 of ARR, but your revenue's been completely flat all year. So how did you calculate that? Oh, well, we just closed this big deal and we multiplied it by 52. Like, okay, well, that's not how you do it, So there's lots of little things like that you'll kind of find in due diligence. You kind of look at, you start digging into like, who are the co-investors, which isn't really important, but, you kind of want to know, as a small check, I don't want to come in at the beginning of the round and have you run out of money, right? That's another thing I'm looking at. That's why, like, if you land $1 million check in your round, you're going to have such an easy time raising another 500 to $1 million. You're like, I already got $1 million in. And you're just kind of looking through you're checking the cap table, you're checking any shareholder loans, you're checking the incorporation docs, IP assignments. You're looking at the safe that you're going to sign and seeing if there's any irregularities. I've made mistakes where I signed safes that pushed a portion of my conversion to common, and I wasn't even paying. I was so early, like as an angel 6 years ago, that I was like, I didn't even read the fine print. So you're kind of like reading all the fine print in due diligence and making sure you're not making any bad decisions. Taking another look at all the things that they said in their deck and in the call, more or less. Sometimes you're calling customers. You're calling some of the other investors that they say are committed to the round. You'll call them and be like, hey, Bob, I'm looking at, fly message with you. What do you like about the deal? Stuff like that. You're doing some back channeling, some background checks. And the list goes on. There's a huge checklist that I have in due diligence, but it's just making sure, like, as a fiduciary of other people's money, that you're dotting the I's and crossing the T's, that you're not making any mistakes with other people's money.
Super insightful, man. I really appreciate that. So inquiring minds want to know, man. I'm going to ask you a tough question. Are you ready to talk to our elite investor, Right Side Capital, to invest in Vingresso's fly message?
Yeah, exactly. Make an intro. I'd love to talk to him.
And you all heard that right there. We might get Team Ignite right on our side right now to close out a deal here with us.
Always be closing. That's the message, right? Like,
always be closing, man.
Always be closing. ABC.
That's exactly right. And and I really appreciate you coming on, Brian. In fact, a funny story for those people listening in. I'll tell you full circle. And this is my first time talking to Brian. I was like, you know what, Brian? You know why I wanted to take this meeting was because you were the one VC that told me something that I've never forgotten. And of all the messages, over 200 and I think 20, 30 angel investor VC meetings, there was one email.
I think I was having a bad day that day when I said that. I think I was like I was kind of like irritable. I was irritable VC Bri that day.
Not at all. Don't even trip off that. No. It actually, because there's a positive message here, right? Like, and so I'm not trying to knock you at all. In this particular case, it was what fueled my fire because I was pissed. I was pissed off. And all of you listening, you're like, what exactly did he say to me? So originally,
I totally forgot when you told me the story the other day.
Yeah, Brian says, no, I'm not. I'm not interested. And of course, as a founder, even as a salesperson, whenever someone tells you no to a deal, your objective is to find out why. Like, what did I say? What did I do? What is about the deal? What don't you like? Because you learn from those either a mistake or an objection or whatever it might be. So I was always in the habit of, tell me why. And I'll never forget it. It's right here. It's right here in my brain. You wrote, I know a lot of people over at Google. Google's going to eat your lunch. And I laughed over that, and I was pissed at the same time. And then I turned around and I said, No. He has no idea what we are doing. I'm going to get this guy. And so over the course of time, I built a relationship with you course of time, and we're still, having conversations, which I appreciate, and I'm looking forward to potentially working with you guys at Team Ignite. But those are the types of things.
I think this was like right when they were, the whole co-pilot craze was happening. We're going to integrate ChatGPT into all the surface areas like Gmail, and Microsoft's doing the same with their Outlook. And I was like looking at your product initially, and this is just initial look, right? And I'm like, I don't see the need for this,
And by the way, you were not alone, right? There have been plenty of folks that have said, you know what, productivity, writing assistant, software, and I was like, no. We gotta take this a step back, like, right? So it was not wrong. You were not wrong, and it was clearly your opinion, and I respected your opinion. In fact, I just wrote back to you saying, hey man, I think my message was, I think you got it wrong. That's not exactly what we're doing. I'd love to be able to sit down and talk with you. And then eventually, over the few months passed, we came back together. So I think it's such a great story, because anybody who's listening in,
don't take no for an answer.
First off, don't take no for an answer.
Never take no for an answer. Yeah.
And also let somebody else's poo-pooing on your idea. If you truly believe that it is like the next greatest thing, then let that fuel your fire to the next meeting, to the next opportunity. And also, by the way, no right now doesn't mean no forever.
And keep receipts. And then that way, when you have a podcast, 6 months later, you can bring it up with the guest on your podcast.
And by the way, bro, I'm not doing it to knock you. It truly was inspirational for me. And I want you to know that. And all my listeners listening in right now as well. These are things that as founders, it hurts when someone says your kid is ugly.
Aye.
Right, like if your best friend said, "Hey man, congratulations on the new baby, but that's one ugly baby."
Yeah, are you sure that's even your baby? No.
Like, bro, you're not calling my baby ugly. So that having been said, it's good, man, and I love the fact that as founders, we have the opportunity to grow and to develop. But sometimes we get all those no's.
Well, and here's the message too. I would tell founders is VCs never say no forever.
Fair.
We always leave that door open. It's always like it's a no right now. We'd like to see more traction. It's a no right now. We want a technical co-founder. It's a no right now. Yada yada yada. Right? And because there's no bad idea. It's just bad timing. Right? We didn't even talk about that. That's one of the most important things in my framework is timing. And it's the hardest thing as an investor to get right. Like why you? Why now? Why is this Instacart instead of Webvan? And you're trying to kind of suss that out, because every idea will probably eventually be done in some way, shape, or form.
Yeah. And that was actually to your point. One of our recent discussions, you actually asked me like, all right, bro, there's a few players out there in these different categories. Like, what makes you unique? Like, help me understand that. And listen, as a founder, you got to be able to nail it, and you got to be able to articulate it. And if you can't articulate it, that might be the difference between you surviving and not surviving. That having been said, Brian, it's super awesome, man, to have you on the podcast. Hey, if someone wants to get a hold of you or get connected to you, what's the best way? Is it LinkedIn? I heard you say you got like 50 connections a day, but what's the best way?
Yeah, I mean, you can reach out. I'm an open profile on LinkedIn. Feel free to just shoot me a message. I'm sure if you search Brian Bell, Team Ignite, or you go to teamignite.vc or teamignite.ventures. I'm Brian at teamignite.ventures is my email. Reach out. I'm happy. There is a form to pitch us. It's pitch.teamignite.vc. And that will go right into my inbox. I'll take a look at what you sent me, and I look at every single pitch, and get in touch.
Make sure you send a personalized connection request message that says, "Hey, bro, I heard you on the Modern Selling podcast. Great show with Mario Martinez." So this way he knows exactly where you heard him from. Brian, I got one last question for you, man, and that is your all-time favorite movie. What is it?
Oh, Shawshank Redemption, hands down.
Everybody gets Shawshank Redemption. I love it. That it's a movie that you cannot forget, and that is very impactful and super memorable. There you have it. Shawshank Redemption it is. For all of you listening in right now to this podcast, hey, do me a favor. Don't turn that dial quite yet. Listen to this very important message. Thanks for listening to the Modern Selling Podcast. please do me a huge favor and give the Modern Selling Podcast a 5-star rating and review on iTunes. Oh, and don't forget, if you'd like to save 20 hours or more in a month and increase your productivity, go right now and download Fly Message, that's flymsg.io, for free. It's your free text expander and personal writing assistant. Hey, thanks for listening in, and until the next episode, good selling.